Let's start with the gold prices, which are marginally lower now, trading around that $1,300 per ounce mark. You have seen prices look at concerns around tensions in Ukraine that could escalate, while platinum is continuing to outperform as a strike across South African platinum belt enters a third month. On your screen, though, 0.25% of decline coming in for the gold prices. Take a look at the energy space, where the Brent is still holding around that 109 a barrel, near 7-week highs. Tensions have mounted in eastern Ukraine, and Libya also has delayed the reopening of a damaged eastern port. That's showing onto the prices, 0.25% up for the Brent there. Let's get on board then. Vijay Bamwani, who's author and CEO at bsplindia.com. Also joining us is Ajay Kedia, who's MD and research head at Kedia Commodities. We also are now joined by Mark Heenan, and he joins us from Cross Commodity Research at Asia Society General Corporation. Welcome, gentlemen. Vijay, let's start with you first. And we are looking at truncated weeks continuing into the Indian markets. What's your sense now on the volumes, and especially for the precious metal space?
Manisha, volumes in this week are likely to be truncated, like you rightly mentioned, because of one trading session short due to a holiday. And the outlook on precious metals will be completely news-driven, what with action hotting up in Ukraine. Now, there is talks gaining momentum about impeding sanctions, and sanctions will basically impart volatility to precious metals. If at all there is a stepping up of the rhetoric, my guess is gold might inch up slightly. And what is actually aiding the sentiments is the domestic Akshaya Tritiya festival and the wedding season in the Indian subcontinent. So I would think that downsides are likely to be met with buying support, and the 28,600 levels on gold will be a level to watch out for as a temporary support for now.
Mark, what's your sense really coming into the markets? Because there has been a recent shift in the U.S. monetary policy. There's gradual policy normalization happening elsewhere as well. What kind of an impact of that do you see coming in for commodities?
The policy normalization that you speak of, and by extension rising policy rates, is generally very supportive for commodity prices, as it is seen as a sign of strength and not weakness. So that's the overriding factor, and that is very good for commodity fund flows. In terms of the volatility component, with reference to emerging markets, and again in the context of rising policy rates, that tends to be expressed through weakening emerging market currencies, which typically affects the agricultural and some of the meat commodities, insofar as exports from a lot of these producing countries can be affected.
Ajay, let's get your view as well on the gold and silver prices. I mean, we did start the Asian markets on a positive note. It has seen a turnaround coming in right now. What's your sense on the prices going forward?
Good evening, Manisha. As we look, gold was continuously outperforming last week. No doubt tensions again in Ukraine has supported our prices, but I think 1270, 1272 was the good support level in international, and from where we have seen a good buying coming on. So up to Wednesday, we expect prices to be in a positive trend, may test around 1318 or 1326 on higher side. No doubt on domestic market, two major factors are important. First of all, Akshaya Tritiya and wedding season has started. Already premiums in spot market has gained up. Secondly, no doubt 28,000 was acting as a very good support, and there has been market sentiment at low level. Buying will continue to emerge ahead of festival season. So maybe we can see a rally continue up to 29,200 or 250 level on high side. Similarly, in case of silver, still in international trading in a wider range of $19 to $20. Domestically, we have seen a very good bounce back from 42,000 mark. May see a jump around 43,200 or 400 level, but focus will be on FOMC meet that is scheduled on Wednesday. After that, only fresh clues will be there in the bullion market.
Mark, to you as well, what's your sense now coming in for the precious metal space? There's lots happening in the international markets, but India is celebrating a gold buying festival this week.
Gold is a little bit different from the rest of the commodity complex, often viewed as half currency, half commodity, and that is bearish for gold. We've had a very clear downward view on the gold price since the beginning of last year, guided lower by the policy normalization in the context of rising yields and rising rates. Furthermore, gold additionally hasn't really been behaving or responding as a safe haven to many of these emerging market issues. Certainly at the beginning of the year with the emerging market rout, there was a very small rise in the gold price, a little bit pathetic in a way. Was quickly sold off, moving all the way through to the most recent Ukrainian conflict. So its appeal as a safe haven is diminishing, and the broad framework of policy normalization and rising rates will steer gold lower.
Mark, also with China in a bit of a spot now, would you look at the industrial metal prices come under a bit of a pressure?
Industrial metals are very sensitive. The most sensitive of the 5 main industrial metals is copper, by far. We saw that last month with a very swift decline in prices of around 10% following the default in the solar corporate bond company in China. And copper is particularly sensitive because, first and foremost, China uses about 40% of the world's copper. Number 2, copper is currently trading at about 40% above its 90th percentile cost of production. So it doesn't quite have the cushion that many of the other metals have that are trading at or below their cost of production. Secondly, copper at the moment is going through a period of rising mine supply growth. There's a lot of new supply coming on stream. And fourthly, possibly most significantly recently, and possibly the least understood area, is copper is used in these collateralized loan structures within China. It's a difficult area to understand, but in short, copper is the collateral in these loans that underpin many of these shadow banking structures. And the view is that if there is any policy normalization in China, or a slowdown in China, or any tightening in any capacity along those lines, that might trigger an unwinding of these structures, or at the very least a slowdown in the amount of copper that's imported into China for use in this collateralized loan.
Vijay, what is your sense? As Mark says that copper is trading 40% above its cost of production, so that means there is still way lower onto this one. You haven't been very bullish yourself on copper prices, but nickel as well. How do you look at both these metals?
Manisha, I would seek short selling opportunities across the industrial metals complex, because I don't see any signs of exuberance on my screens. And where copper is concerned, I think 2% higher from here, I would be happy to start initiating shorts. Where nickel is concerned, 1135, 1140 kind of levels, I would feel happy to start pressing shorts. I think the sluggishness in the industrial metals is all pervasive, and it's been evident since late December 2013. I think the possibility of a drawdown is slightly higher than the possibility of an upthrust. And whenever rallies do occur, they're not really very convincing. The volumes and open interest don't show signs of greed or exuberance in the trading community. And it's more of short covering that fuels price upthrust rather than any concerted buying. So unless I see at least a significant previous high being taken out on copper, which would be at 434 odd levels, I would want to seek short selling opportunities on upthrusts.
Ajay, what's your sense on the base metal space? Which one are you picking up as a strategy?
Yeah, surely out copper and nickel only, because copper already we have seen in the month of March there was a sharp fall coming in the prices, but now since last 10-20 days market was trading in a very tight range of 398 in lower side and 410 on higher side. As we have seen a breakout of 410 seems to be slightly supportive for copper, may see around 426 on higher side, but sustaining at that level will be slightly risky. Coming in case of nickel prices, it has already gained by almost 30-32% for this year. Still we expect that the supply concern will continue to support the prices, but technically market is highly in overbought situation. No doubt open interest has tremendously gained once the prices has broken 1100 level. So short term may we see a jump around 1160, but be cautious in nickel because technically overbought, may see a correction.
Mark, let's get in your perspective as well on the nickel prices. An outperformer clearly, more than 30% up for 2014. How are you trading it?
Yeah, nickel's doing very well, suffering from, or rather helped by two new factors in the nickel market. One is the halt of Indonesian ore exports that was imposed earlier this year and has been adhered to. The market at the beginning of this was largely of the opinion that this ban on ore exports would fall away, but it's still very much in place, and the Indonesians have done this to increase smelting capacity within the country with a view of finally exporting refined nickel, which is much better, obviously, for the Indonesian economy. The other component to this is the threat, again, of sanctions from the West on Russia, but applying to metals this time. And that is likely to go through if we do have sanctions imposed. And Russia is a significant supplier of nickel into the world, and so that will affect nickel exports from Russia as well. So those two factors have added a significant risk premium onto the price of nickel currently. And in the context, even without these two factors of rising economic growth, rising stainless steel demand, we're forecasting stainless steel demand up 8% in this current year. And so it's a confluence of both bullish supply and demand dynamics within the nickel complex and these two geopolitical Indonesian and Russian issues.
All right, Vijay, what's your sense also coming in for the energy space now? Because that has been doing good, especially the Brent prices.
Manisha, here again, the rally is more due to fears of supply-side constraints rather than any kind of bullishness either in the fundamentals or in the technicals. I think at 112 odd levels, Brent crude will start to experience the heat of selling. As far as the MCX prices are concerned, I would still maintain that 6,330 to 6,350 band remains a very strong resistance in the absolute near term, and rallies would be invitations to go short.
It has been a good day for most of the commodities in agro space. Take a look at guar, and it has been a consistent upper circuit coming in for that space. It's the monsoon concerns which has taken the prices higher. Should get a weekly or a monthly chart on that one really, because that one really seems to be doing good in last 6 or 7 sessions now. Take a look also at the soybean prices, because we've done quite well onto this one as well. Nearly 2.5% to 3% of gains coming in for soybeans. Soy oil is doing well. And most of the spices, as we have been talking in the recent days, also seem to be performing on the better side. Vijay, what is your sense? How would you look at all of these commodities?
Manisha, food inflation is something that I've always advocated will be sticky, and you have 2 or 3 pressure points which are likely to push prices higher. Number one, you have a food security bill which will demand higher allocation and offtake. You have the El Nino fears, and now there are some rumblings of an overestimation of buffer stocks of all kinds of food commodities. So the sentiments are fairly gung-ho where agri-commodities are concerned. Unfortunately, it's bad news for inflation, but reality at the ground level says that you should be seeking buy opportunities on declines, especially in edible oils, especially in probably grains like wheat. And even pulses would meet buying support at lower levels. So I would wait for 2 or 3% declines and start shopping very selectively.
Ajay, what's your sense in pulses and edible oil? How would you want to trade chana and soybean for the very near term?
For all agri item, I think chana, turmeric and soybean are the outperforming counter for next 2-3 months. No doubt, since last 1 week we have seen a good rally coming in soybean counter. No doubt international factors are quite supportive. Brazil size of production is slightly dropped as compared to last year. That has supportive news for international, whereas domestically monsoon factors as already updated this year, the monsoon will be slightly low as compared to an El Nino factor is again supportive for soybean prices. No doubt technically market has rallied very well in last 4-5 sessions, but despite this rally, fundamentals are quite supportive, may breach 5,000 level in coming session. Coming to turmeric, already spice pack, we have seen a very good rally. Prices has gained above 7,000 level also. Farmers are not willing to sell at ultra low prices. May see a jump around 73, 73.50 on higher side.
Also, what's your sense on chana prices, Ajay? Because that's another thing that has been rising on the higher side.
See, arrivals in China is quite high in the month of February and March. Now slowly and steadily arrivals are dropping. Ahead of festival season, we expect a low level buying continue to be supportive for China prices. No doubt last week we have seen a fall in the prices to the tune of 3055, but I think 3050, 60 is a good level to take and hold the position for the sake of 1 month. Maybe jump around 3250 or 3300 can be seen.